You just got an email from your retirement app. It says your portfolio is now AI optimized. A little robot icon blinks next to your balance like it's proud of itself. You feel relieved. Something smart is finally watching your money. But the real answer to what that AI is actually doing is far stranger and far less comforting than the icon wants you to believe. Here is the uncomfortable starting point. Most of what gets marketed to you as AI-powered investing is not intelligence. It is automation wearing a costume. And the difference between those two things could quietly cost you your retirement. Think about what AI optimized is supposed to mean. A system that studies markets, adapts in real time, and outperforms a human advisor who sleeps and gets emotional. That is the pitch. That is the icon blinking on your screen. But ask yourself something simple. If an algorithm could reliably beat the market decade after decade, why would any company sell it to you for a 0.25% management fee instead of using it to become the richest entity on Earth? That question is not cynicism, it is basic economics. And it points at something economist Eugene Fama proved decades before AI was even a marketing word. Fama's efficient market hypothesis, which won him a Nobel Prize, argues that asset prices already reflect all available information almost instantly, which means any edge a piece of software finds gets erased the moment enough other software finds it too. Millions of investors and now millions of algorithms are all staring at the same public data. The edge doesn't last. It can't. So what is your AI retirement tool actually doing behind that friendly icon? Mostly, it is doing what's called robo-advising, sorting you into a risk bucket based on your age and a 5-question quiz, rebalancing your portfolio between stocks and bonds on a schedule, tax loss harvesting, which is a real and useful feature, but one that existed long before anyone called it AI. Vanguard, one of the largest asset managers in the world, published research on what it calls Advisor's Alpha, showing that the biggest value an advisor or automated system adds isn't picking winning stocks. It's behavioral, keeping you from panic selling during a crash, keeping your fees low, keeping you invested consistently over decades. None of that requires artificial intelligence, it requires discipline. But discipline doesn't animate a cute robot icon, so companies sell you the icon instead. Here's where the story gets darker. In 2023, the U.S. Securities and Exchange Commission charged 2 investment firms, Delphia and Global Predictions, for what regulators called AI washing. These firms claimed their models used artificial intelligence and machine learning to make investment decisions on behalf of clients. The SEC found those claims were false. There was no meaningful AI doing the work regulators were told about. It was a label, a costume on top of ordinary strategies sold specifically because AI sounds like an unfair advantage you'd be foolish to pass up. Now hold that next to your own 401k dashboard. When it tells you your portfolio has been optimized, do you actually know what changed? Or did you just feel better because a smart-sounding word appeared next to your money? This is the counterintuitive twist that should genuinely worry you. The rise of AI-labeled investing tools is not primarily a story about better returns, it's a story about better marketing wrapped around the same old products, sometimes with higher fees attached for the privilege of the label. Research from Morningstar, which tracks fund performance across the industry, has repeatedly found that lower-cost index funds outperform the majority of actively managed funds over 10 and 15-year periods, long before any of this was rebranded as artificial intelligence. The single most reliable predictor of a fund's future performance isn't a sophisticated algorithm, it's the expense ratio. The cheaper the fees, the better your odds, almost regardless of who or what is picking the investments. Which raises the real question you should be asking about your own retirement account. Not, is this AI powered, but what am I actually paying and what am I actually getting for it? Here's the modern mirror, and it connects back to something far older than any algorithm. Financial writer and Vanguard founder John Bogle spent his career arguing something that sounds almost too simple to be true. He believed that trying to beat the market is, for the overwhelming majority of investors, a losing game once you account for fees and trading costs. His solution wasn't smarter technology, it was owning the entire market cheaply and getting out of your own way. Decades later, the AI-labeled tools flooding your app store are, in most cases, just automated versions of Bogle's original idea, repackaged with more expensive branding. That doesn't mean every AI-adjacent tool is worthless. Some genuinely use machine learning for things like fraud detection, tax loss harvesting timing, or predicting when you might need cash reserves based on your spending patterns. Those are legitimate, narrow, useful applications. The danger isn't that AI touches your money at all. The danger is believing AI is a synonym for guaranteed smarter than you, when the honest answer is that nobody, human or machine, has cracked reliably predicting the market. Not Renaissance Technology's famous medallion fund secrecy, not Wall Street's most expensive hedge funds, and certainly not the free robo-advisor bundled into your banking app. So here's what actually matters when you're deciding where your retirement money goes. Ask what the fee is in plain percentage terms and compare it to a basic low-cost index fund. Ask what specifically the AI is doing differently from standard rebalancing and diversification, and if the answer is vague marketing language, treat that vagueness as information. Ask whether the tool is keeping you invested consistently, because Fama's research and Bogle's philosophy point to the same conclusion from different directions. Time in the market, low costs, and not panicking during downturns matter more than any algorithm's supposed cleverness. Your ancestors, so to speak, in the world of investing weren't chasing shiny new labels either. They were compounding quietly, decade after decade, through recessions and bull markets, trusting boring diversified ownership over clever timing. The tools have changed. Robo-advisors replace paper statements. Apps replace phone calls to a broker. But the underlying physics of building wealth hasn't moved an inch. Costs matter. Consistency matters. Marketing does not. Here's the last thing worth sitting with. The blinking robot icon on your retirement app isn't lying to you exactly. It's just speaking a language designed to make you feel something specific. Relief, trust, a sense that the hard thinking has been outsourced to something smarter than you. But the smartest move available to you was never hidden behind artificial intelligence. It was sitting in plain sight the whole time, in the fee disclosure page you probably scrolled past in the decades of research from economists who never needed a robot icon to prove their point. So the next time that email arrives telling you your portfolio has been AI optimized, don't feel relieved. Feel curious. Open the fee schedule. Compare it to a basic index fund. Ask what specifically changed, because the real answer to whether your money is being watched by something smart was never about artificial intelligence at all. It was about whether you were finally paying attention yourself